My name is Janet Chin. I'm the Career Specialist for the Berkeley Master of Financial Engineering program, the MFE. So the MFE is a quantitative finance program, but we're also tackling data analytics and data science, and we place our students in fintech technology firms, including Google and Lending Club, as well as financial institutions, Citi, BlackRock, and more. We're very excited to host this annual event and welcome you again. I work with our executive director, Linda Kreitzman, who couldn't join us tonight, but extend her warmest welcomes to you as well. The MFE launched in the summer of 2000. To date, we've graduated 15 classes. Our 16th class will be graduating in just 2 short weeks. We have some of our current students here as well. So you'll have an opportunity to speak with them and, of course, our panelists. And so without further ado, let me introduce to you, actually, I have to mention, this event is made possible with sponsorship from the IAQF, the International Association of Quantitative Finance. We thank them for their partnership. They represent MFE programs across the US, and you can find more information about them on that pamphlet. But I'd like to introduce to you Andrew Alden. He is one of our many alum. He graduated in 2013, currently with Weatherstorm Capital, and he will lead us tonight as the moderator. And so please welcome Andrew as well as all of our panelists.
All right, thank you very much for the introduction. So my name is Andrew Alden. I am currently head of quantitative research at 2 firms, Weatherstorm Capital and Vidant Financial. They're both essentially owned by the same people, so that's why I have 2 titles. And at my company, I research, design, and build quantitative equity strategies. So in plain English, I pick stocks and build portfolios. A lot of my job day to day consists of downloading data, processing data, doing research to look for signals that drive stock returns, and then ultimately finding ways to combine those signals, optimize a portfolio, and deliver it in an index so that an ETF can track it. So my firm is an ETF firm. You're obviously very familiar with BlackRock, I assume, who has gazillions of ETFs. The direction that industry is going is to deliver what are known as multi-factor or smart beta portfolios or ETFs that are designed to do a lot of the thinking that an active manager would do, but do it in a systematic way to deliver returns for the investors. So that's a little bit about what I do. And since this event is called How I Became a Quant, I'll also tell you a little bit about my path to get here. So about 10 years ago, I came out of undergrad with an economics and finance degree, and I moved to the Bay Area and wanted a great career in finance. And basically, I got a job watching other people do cool stuff. So I got an entry-level job. Essentially, I was processing the trades that hedge funds were doing. So I got to see, a whole bunch of different hedge funds, what they were doing, the trades they were putting on, stuff like that. But everything I did was watching cool people do interesting things without doing it myself. So a couple of interesting, things during that time. One, if you're familiar with The Big Short and Michael Burry at Cyan Capital, he was played by Christian Bale in the movie. He was one of my clients. So I was watching his trades and I was watching everyone else lose a ton of money, and he made a whole bunch of money and then closed his fund down. The other cool thing that happened at that time was Kevin's firm was also one of my clients. So I watched his cool trades and work with that portfolio for about a year. At about that time, I was really trying to, really thinking about how can I do the interesting stuff? How can I pick the stocks? How can I build the portfolios? And I essentially realized I really needed a lot more skills. And one of the reasons why I like doing this event is that at about that time, I happened to be in a bookstore in New York, and I saw a book called How I Became a Quant. And it was a lot of, I don't know if some of you have seen the book, but it was a lot of, hedge fund managers, people in finance, et cetera, who were telling their stories about how they, usually started off in science or started off in other fields and found their way into quantitative finance and had a great career. So that was pretty inspirational to me, and so I enjoy coming back and moderating this event. This is now the second time for that reason, because it ties into sort of my own personal story. So after a while, I did realize that I needed to get the skills to do the cool stuff. So I looked at the MFE program here, applied. And thankfully for me, even though my background was economics and finance, I'd also done a bunch of programming, stats, math, and sciences, because I'd thought about doing a couple of different things. And so I had the background that made it relatively straightforward to apply to this program and go this route. So out of MFE, I more or less got straight into what I'm doing now, and that's been great. So developing those quantitative skills, was really critical for the path that I took to, get doing the interesting stuff in finance that I very much enjoy doing today. So I think at this point, I'd like to, turn it over to all our panelists. And instead of introducing each of you, I actually would love to have you each introduce yourself. Tell us where you work, what you do, and a little bit about your path to get there. So Rajat, you want to start us off?
Sure. Is on? Okay. So hi, I'm Rajat Agarwal. I work at Lending Club as a senior director in the investor group, focusing on capital market structuring and investor analytics. My path has been I started my career in finance at Deutsche Bank in the rates analytics team, doing quantitative modeling for interest rate trading desk, building some quantitative strategies, portfolio monitoring for our hedge fund clients. And then I saw a lot about the things that quantitative finance people do, but I didn't have a solid understanding of what's going on, how the models actually work. So I tried to pursue a financial engineering degree from Berkeley to get a sense of all the basic understanding of quantitative finance. After that, I went on to pursue an opportunity at Goldman in the investment banking division. It was a new group they were setting up, advising financial institution clients on derivative structuring and few other balance sheet optimization strategies. So I could immediately put my MFA degree to good use there. It was a great experience for 5 years, and then I saw a trend evolving with so many regulations coming in, the new fintech space evolving, and Lending Club appeared to be a great opportunity for me to pursue in the credit space. It linked well with my background, so I decided to pursue an opportunity at Lending Club. That's in short about me. You want to go ahead?
Yeah, sure. Hi everyone, my name is Maggie. Currently, I work on product analytics at Google. So I work for Google Photos. It's a really new product. It's been around for 2 years since I/O 2015. So to a larger extent, it feels like I'm working at a startup. It's really disorganized, as you would not imagine what will happen at Google. So my path to where I am right now is it's kind of different and unconventional, and I'm not saying that you should follow. So I started my career in finance as similar to what Andrew has mentioned. Like I watched all the cool hedge fund strategies. I worked on investment performance analytics at Canadian Pension Plan Investment Board about 4 years ago. So I worked on their external fund. Basically, it's fund of hedge funds for the pension plan. And I was always wondering what's behind the strategy, and since I studied mathematics and statistics for my undergrad, and I always wondered why the performance goes that way, why the investment strategy was constructed that way. So the experience at CPPIB kind of led me to pursue a financial engineering degree at Berkeley. And when I was at Berkeley, I think maybe unlike most of other people, I came in with a really open mindset. I just wanted to learn, I wanted to explore, and I didn't really set my mind into like quant finance. So at Berkeley, I not only took classes offered by Haas, but I also went to listen to some of the statistical class and econ classes. And later on, I became really good friends with an econ PhD student here who later on introduced me to something called data science. And after my internship at BlackRock, and I decided to just give it a try. So I landed my first job after MFE at Twitter as a data scientist. So in there, I learned a ton and working with a lot of social media data and working with product managers really opened my eyes around what I can do with my quantitative background. And later on, I didn't plan to change the career, but I started at Google about 3 months ago, working on photos, and right now my day-to-day job is really focused on user behavior. What that really means is that you look at, it's really product driven, so you look at what users do with the product, based on really individual data, and later on you aggregate the data doing some kind of machine learning algorithm to cluster it and try to tell what kind of user it is. And based on the aggregate data, you can extract some insight around the product and later on to feed our product roadmap. So, yeah, I'll pass it to Kevin.
Is this working? Okay. I'm a little nervous now because Andrew's seen my trades. And I think Maggie may have seen our marketing pitch when we used to pitch to CPBIB. So I have to be careful what I say here. As you can tell, I do a lot of things, so many things that you can barely fit all my jobs on the on my name card. I do really two things right now. I teach a course in dynamic asset management here on the MFE program, and then I have a consultancy that I just started where what I do is really help non-quantitative institutional investors bring quantitative techniques into their investment process. In terms of how I got started in the business, it really was in the early 1990s. I did an MBA at London Business School, and during the MBA, you were allowed to take part in the PhD seminars. So I took part in those, and that was quite unusual for an MBA student at that time. And I just really loved the I guess the rigor and detail of the research process that was coming up in these academic papers, and there was just a lot of papers that we read that were suggesting there were these market inefficiencies that could be exploited. And when I got out of my MBA program in London, I got hired by Barclays, and they had a tiny quantitative research group that was trying to do some of this stuff, basically building models to forecast equity and bond returns or stock returns. And I ended up working in that group and running the team. And we had a really successful stock selection team that was essentially running what are now called smart beta portfolios. I wish we had come up with the name smart beta back then, because I could have retired a little earlier. But it was early stages. Very few people were using quantitative tools to run equity portfolios in those days. So I did that for a number of years, and that was all in a long-only sense. And what I eventually realized is that we were really only putting kind of half the model to use. Right? We had all this information about stocks that were going to go down in price, and we weren't able to take advantage of that. And so I kind of lobbied the CEO at the time, Blake Grossman, and said, I think we could start a hedge fund business here and take advantage of the model's forecasting power on the short side. So he allowed me to go ahead and set up a hedge fund at Barclays. And I sort of got lucky in that no one wanted to help me. Barclays had tried to set up a hedge fund in San Francisco in 1996, and it kind of lasted for a year or two and then blew up. And so people were really nervous. They didn't want to be associated with what seemed like a risky product at the time. So this is like the late 1990s. Institutional investors weren't running hedge funds. So I say lucky because it meant that I kind of had to do everything myself, right? I had to do the modeling, the portfolio management, even go out and raise the money. And that experience helped me when I left in 2002 and set up my own firm with a Berkeley grad called Peter Algert, who was working for Barclays in San Francisco. So the two of us set up a firm in San Francisco in 2002 called Algert Cold Iron Investors, and we did quant equity, both hedge funds and long only, primarily hedge funds. So it was global equity stock selection, market neutral, long short, typically levered anywhere from kind of 2 to 6 times the size, depending on the product. And so Peter and I worked together until 2014 when I sold my half of the business to him and took some time off. And more recently, like I said, I've started teaching and then started advising some non-quantitative clients on ways they can import quantitative techniques into their process.
So I'm Louis Odette. I'm in the research department at Citi. And so what we do in research is publish reports, send them out to the firm's clients, and try to help to inform their investment processes as part of the services that the firm offers to trading clients. I've got 2 areas of coverage within that mandate. One is U.S. small and mid-cap equity strategy. So a little bit more of a traditional role there. Try to put out forecasts for market direction, suggest whether investors should be biased towards growth or value stocks, which sectors they should overweight or underweight in the portfolio, and maintain a focus list of individual stocks that our fundamental analysts cover as well. The second area of coverage is exchange-traded funds, so kind of syncs up with what Andrew does. And that's pretty wide open space. We're one of the first teams on the street to cover ETFs from research. So there we look at a variety of things, monitor flow trends, product launches and closures, any regulatory developments, since the regulatory framework around ETFs is still developing, since they're a relatively new product within finance. And then also look for information that we can extract from ETF data that might be relevant to investors in the broader asset classes that the ETFs track. As far as how I got where I am today, so undergrad, I went to Dartmouth, was an economics major, math minor. Following graduation, worked in mergers and acquisitions consulting, and really enjoyed that work, but realized there was this whole area of finance out there where I could put my quantitative skills to more direct use. So looked into graduate programs, enrolled here in the MFE program at Berkeley. Following graduation, I went and worked for Moody's for a couple of years, modeling mortgage-backed securities. I graduated in 2009, so this was the aftermath of the financial crisis, and Moody's had a software tool that had been predominantly used by people structuring mortgage backs, and they were trying to repurpose it for investors to do portfolio surveillance and risk analytics. And as part of that initiative, they had to build out a library of waterfall models for all the mortgage-backed securities deals that were outstanding at that point. So I was involved in that effort, and then also some customization work and implementation on the client side. And yeah, was there about 2 years, and then moved over to Citi, and have been there a little over 6 now.
Hi, I'm Mike Ryerson. So I am a senior researcher at a hedge fund here in Berkeley called the Volion Group. It was founded by a Berkeley stats professor named John McAuliffe around 2007. I joined about a year ago. We use machine learning and data science to develop systematic trading strategies for global financial instruments and manage those strategies on behalf of our clients. In terms of the background and how I got here, we're going to play like I feel like I have 1 degree of separation from pretty much everyone on this table. I was a math computer science undergrad at Duke, not Dartmouth. My wife went to Dartmouth. Maybe that's our connection. I wound up in getting my PhD in finance at an undisclosed institution to the south of this campus. And then at the end of that time, I was wrapping up the dissertation, realized I wanted to go into industry instead of academia. Found myself as a statistical arbitrage trader for Citi, another connection, for a couple of years in New York, and then moved back out to the West Coast to join Barclays Global Investors, though missing my colleague here by about 2 years. There, I worked in fixed income research, developing trading strategies for interest rate products. BGI was eventually acquired by BlackRock, and my time at BGI, we launched a fixed income quant hedge fund. So I eventually was in charge of running research for that fund, which grew to be the largest hedge fund under the BlackRock umbrella. Between BGI and BlackRock, that was about 10 years in those roles, and then decided I got excited about machine learning, excited about data science, and thought that there was an enormous potential and opportunity for that area of research and work to just transform what quant finance was. The marketing and advertising people were way ahead of us in leveraging that stuff, and so I got to know the folks at Volion, and thought it'd be fun to try working for a small institution for a change, and been there about the last year.
I'm Emmanuel. I'm a senior researcher at BlackRock. Mike and I worked together for a few years. So there I cover systematic strategies for hedge fund, long-only institutional, and then long-only retail products in securitized credit and mortgage-backed securities. The way I got into there is actually very brief. I spent too many years of my life in school, and then I realized that I knew a lot of stuff that I had no clue what to do with it. So I decided to move to the US, where it's a little bit more pragmatic in terms of actually being able to do a job. So my first experience with finance is actually my internship in MFE. I went on the prop trading desk in New York, covering a wide array of products. Really liked it. Got subsequently another job at another prop trading desk in New York, trading same products I cover now, but very fundamental in nature, and realized that we were fundamentally speaking different languages between my former boss and myself. I mean, besides my terrible accent. And so I figured it was probably time for me to go back to doing some more math in how we think about the investment process, how we design solutions, and effectively how we think about generating more money for the customer. So that's kind of how I got into it. Very brief and concluded.
Great. So one thing I'm thinking might be helpful to everyone here is just perhaps you can each talk us through, what your day looks like. What are the things you do? What do you walk in the morning? What's the first thing you do? How does a typical day play out? Is the job high stress? Is it tons of pressure? Is everyone competing? Help paint a picture of what life at work is like as a quant.
Sure. So before I tell the description about my day at work, just wanted to give a little bit overview of what Lending Club does. So some of you might have heard of the term fintech. There's a lot of innovation going on in the financial space. If you think about a traditional bank's business model, they originate loans and then they keep it on the balance sheet, and the way they fund the loans is through deposits. So you as a depositor deposit money in the bank, and you get about 10 basis points or 20 basis points of interest on your money, while bank goes and lend it out at 3, 4, 5% up to like 10, 20% in the case of credit cards. And that spread goes to the bank, and they are still able to make money even though they have been traditionally very inefficient, using brick and mortar process, heavily regulated banks, and still they are able to make money because the spreads were too tight. So what Lending Club saw is like there is definitely some inefficiency here. We created this online marketplace where we can match the people who want to lend money to the people who want to borrow money. So the little bit difference, because your deposits are completely safe versus what happens at Lending Club is the borrowers or the investors end up taking the credit risk of the borrowers. But essentially you are making higher returns also. So it's a product that fits to some investors, and some borrowers also like it because of the efficiency and the online process. So what my role there is, I am part of the investor group, and as you might have imagined, since Lending Club is not a bank, it does not have access to stable capital like the deposits. So we try to diversify our sources of funding. We have retail channel where retail investors invest into our loans. We have institutional investors, banks also buying through our platform, and we access capital markets. So capital markets is a wholesale way of getting funding. So you can actually raise some debt against these loans that you have issued, securitized by these loans, and this is a way to get wholesale funding in the market. So what I do at Lending Club is support the securitization business. We are planning to come up with like series of securitization deals in the market every quarter, and my goal is multiple folds. A is monitor the capital markets, what's going on in the capital market space, who are the other players who are coming out with deals, what are the deals looking like, what has been the investor reaction or response to those deals, how are those deals performing, work with rating agencies, because it's very important to get these deals rated if you want to access a large set of investors. So my regular day could be very different depending upon what project I'm working on. So it could be, if you're working with rating agencies, you work with them and figure out what kind of structure they would want your securitization deal to have. There are multiple tranches to a deal, how thick or how thin one of the tranches should be, what should be the process around that, who are the investors you think that might be buying into those deals. So it could range from analytics around that, or the other part is the credit due diligence. A lot of investors who are investing into our loans, they want to understand the process. How does Lending Club originate loans? What is the process around it? How do we source borrowers? So there's a lot of credit due diligence that goes into it. And then what is our process around collecting money? What are we doing on the servicing side? So answering investor questions raising from on the credit or on the securitization side, or it could be very broad based also, like what's happening in the macro markets. So the trends in the macro market do impact the performance, and our investors, since they are exposed to the credit risk in the Lending Club loans, they want us to monitor the risk on a very regular basis. If they see delinquencies going up or defaults increasing, they ask questions: what is happening? Why are portfolios deteriorating? Are you seeing similar trends across the industry? What is happening to the traditional card lenders, Capital One, American Express? So it could range on a wide set of things based on what is the focus. In terms of the stress level, I would say it also varies. Sometimes when there is a client deadline or clients are looking for some insights into their portfolios, it gets stressful, and you have to analyze the portfolio. You have to look into the trends, understand the drivers behind their performance. Or it could also be a more long-term thinking. So one of the projects that I'm working on right now is when we sell these loans to the investors, investors think of this as this is a very new asset class. So they haven't really thought of it in a traditional sense. Like what kind of diversification benefits does it provide to them? And given that loans are relatively illiquid, you cannot sell them. So a Sharpe ratio kind of metric might not make sense. So how do you incorporate the risk and return of this asset class and try to explain it to an investor, and how to help him think of it in a holistic perspective? So more if there are more long-term projects, then obviously the stress level remains low. You kind of work on it at your own pace. So it varies quite a bit.
Okay, so I don't have a regular day-to-day right now. As I mentioned before, I felt like I'm working for a startup. So I will start with the time when I actually have a regular day-to-day when I was at Twitter. So at Twitter, I worked on our I worked on advertising, meaning that I forecast our ads revenue and other like ads related metrics. So it's a lot of like time series modeling, a lot of back testing. Like to some extent, I felt like it's kind of similar to some of the things that you do in finance. So my day-to-day is a lot of like writing MapReduce to get the data, making sure the data is right, and then like import it into R or Python, and then build a model, run backtest. So it's a lot of like model-driven, a lot of modeling and a lot of backtesting, and as well as like trying to explain like why the backtest didn't go well, and also trying to explain your complex model into someone who does not have any statistical or quantitative background. In terms of the stress level, it varies, depends on when the earnings come out. So our my forecast also feeds our earnings report, and sometimes we internally, I have a dotted line to our CFO, so he's very straightforward. If he sends you an email at night, he basically expects you to reply in an hour. So I think the stress level is coming from when people want quick responses and quick turnaround. And now at Google, the day-to-day is very different. It really depends on what kind of product we're launching or what kind of experiments we're running. Again, I spend a lot of time trying to figure out where the data sits, because there are just so many different data sources at Google. There are so many people working on different things, and you get I think at Google I get 100 times more emails than I was at Twitter. So a lot of times you just kind of have to prioritize what is important. In terms of what I'm actually doing, so I work on Google Photos. And for now, my partners are product managers, engineers, as well as our machine intelligence team. So my role is more analyzing our user behavior data and trying to extract the insight and communicate that with the product manager, and eventually try to shape our product roadmap. The stress level sometimes depends on, for example, last week we were launching a new feature, and it started with a 1% experiment. So my role in there is more analyzing the experiment and to see whether the differences between the control and treatment actually make sense. So that comes from traditional statistics. You analyze what is significant and what is not, why metrics moves in different ways. It gets stressful when the engineers really wanted to launch it to 100%, but you see the 1% experiment does not make much sense. So, so you don't want to be a blocker on what the engineers wanted to ship things, and you really wanted to also making sure everything goes well on the back end, on the front end, that we're okay to ship it to 100%. And on the other hand, I feel the stress level also depends on how well you wanted to do your work. So if you try hard enough in an environment I am in right now, you really have the power to change what you're gonna launch this product for, because I'm one of the 3 people team who are looking at data that other people on this product is not looking at. So people are putting a lot of trust and responsibility on you in order to tell them, okay, what's going on with our product from a data perspective, and what we should do going forward based on what user habits, what users are doing on the product. Hope that makes sense. And if you are on iOS and you don't use Google Photos, you really should. And we can chat about that afterwards.
Yeah, my day starts at 6:50 every morning when my son gets ready for school, and I have to decide if I should make him a peanut butter and jelly sandwich or ham and cheese. And that's extremely stressful if you make the wrong decision. But back when I was running the hedge fund, my day was slightly different. Even when I was in charge of the firm, I'd like to have responsibility for one portfolio. So I was always trading a particular portfolio. Sometimes it was the U.S., in which case you were up at sort of 5:30. Other times it was Europe, in which case you were up at 11:30 at night, preparing the trade list. And then Asia was actually kind of the nicest because you could sort of prepare the trade list in the late afternoon. But the process of trading in a quant fund is really, because it's model driven, you're not making the buy and sell decisions, but you are getting a model output. And there's typically, for us, because our holding period was 9 to 12 months, it wasn't a high frequency trading strategy. So we would run a kind of a sense check against the model just to make sure it wasn't driven by any rogue inputs. And then the main decision was really what's the execution strategy that's best suited to the particular trade. So if it was a kind of alpha-driven trade, you might chose a more aggressive execution strategy. If it was more risk-driven, you might choose a more passive one. So there was an element of judgment involved in how to send the trades out to the market. So that's part of the day as a quant manager. Another part is going over attribution. So we would have essentially a global dashboard that tracked factor performance in real time across all the geographies, all the sectors. We would split the world down into various categories. So I spent a lot of time just trying to understand what was working, what wasn't. And there was two purposes for that. First, I was kind of responsible for communicating to investors what was going on, so I needed to be on top of it. And then second, you just get a lot of ideas for future research by studying real time how the models are performing. And then the beauty of quant management is that, because the investment ideas aren't generated on the portfolio management desk, you have a lot of your day, even me running the firm, for research. So I ended up spending, I'd say, 30 to 50% of my time on trying to generate new ideas or working with the research team, helping them on their research. So I'd say those three things were constituted most of my day.
Yeah, and I wouldn't say I have a typical day per se, although the steps in the process do tend to be pretty similar and repeatable. Just to give you a sense of the timeline, we usually publish stuff 2 or 3 times a week. So while we do work on some things for longer periods, typically between 1 and 3 days is the type of time frame that we're working on a particular report. So I'd say we maintain a list of ideas that we think are of interest to investors and that we might want to publish on at some point in the near future. And those come from a variety of sources, our own discussions on the team internally, conversations with clients, as well as things that are being discussed in the press or among competitors. So yeah, when we're starting off on a particular report, look through that list of ideas and determine which ones we think are most promising and most relevant and of interest to our investor clients. Then we'll try to identify what are the main questions that clients would like answers to. And then we'll look at the available data sets and try to find some information that we can analyze to try to answer those questions. Then once we've gone through that process of running some numbers and think we have something interesting to say, then the process of writing that up begins. And you want to make sure there are elements of that are similar to journalism, where you want to have a catchy headline that's going to attract attention. I think the market's kind of overserved in research right now, so clients have a lot of noise coming at them all day, so you want to cut through that and make sure you're expressing your ideas clearly and concisely so that they can digest them in a reasonable amount of time and get on to their day jobs as well. So the writing process is pretty focused, and another step in ensuring that you're communicating your findings and your ideas clearly. Then you go through the process of actually publishing it. Research, there's it's highly regulated, so teams of compliance people and lawyers review everything that goes out. And if they have any questions or if they identify anything that they're uncomfortable with, then you need to work with them to get a final version of the report that they're okay with and can be sent out to clients. Once that happens, then the work of marketing the research begins, and that can be making phone calls, sending emails, planning events around a particular topic to make sure that the message gets out to clients, coordinating with the sales force and having them be sort of part of the megaphone that delivers your message to your audience. And then, once that's over, then kind of back to square one again and look through your list of ideas and on to the next topic. One thing I would mention is that, for all the advantages of living on the West Coast, one major disadvantage working in the financial industry, depending on your perspective, is that you have to wake up early. So, stock market opens in New York at 6:30 a.m. Pacific time. You've got to make sure, you're up to speed on any news that might have broken before that, any requests that come in from clients. So I would say, generally speaking, I would say research is probably a little bit less stressful than other aspects of transactional finance. It's, not like the phone is ringing off the hook with customers trying to put in orders all day, but a little bit more of an academic type of culture within the research department. That being said, a lot of times, news will break that you need to react to, and you need to get some thoughts out. You have to publish before you can speak with any clients. So sometimes you are under tight deadlines there, and it's not uncommon for other things, requests to come in, and so you need to multitask at times, and there can be time-sensitive aspects to the work. But generally speaking, working in a research department versus working on a trading floor tends to be less stressful.
Yeah, it's a cliched answer, but I'm not sure I have a typical day. Kind of varies where you are in the life cycle of a project, but working at a small firm, you have to wear a lot of different hats in the from the beginning to end of the research process. A fair amount of your time could be spent working on coming up with a new set of features that you think might be interesting for giving you a new forecasts that aren't captured in your existing models. So what data do I need to construct that feature? How do I go about sourcing it? How dirty and kind of poorly formatted does it end up being, and how do I have to kind of clean it to actually do something meaningful with it? Then there's the kind of data science research part of actually asking, like, what kind of predictions can I build using these data? What impact do they have on the strategy that I might be trading? If I look at, if I knew this information historically, what do my backtests look like? And then writing code to kind of implement that in production and put those changes into the trading system. That process, could, depending on where you are in the life cycle of a project like that, your day can look very different. But a commonality for us, we're founded by people who have software backgrounds. I think my boss wrote the first recommender system at Amazon way back in the day. So we're kind of organized in that. Very much like a software engineering firm, we follow kind of an agile development process. We plan out work on 2-week cycles. So there are certain things you're committed to doing over a 2-week period, and those deadlines kind of matter if other people are counting on you to have some piece of work done so they can start on their piece of work. So I'd say it's not. There's not people screaming and like smashing phones and the kind of cliches of being on a trading floor in the old days of Wall Street. But there's an expectation. You're in a small firm, and everyone's kind of depending on you to get your piece of the work done. And when deadlines come around, there can be a little bit of a push. But it's pretty manageable, and it can be a lot of fun at the same time.
So in terms of my schedule, I would say the hardest thing is starting early. Typically, I start at 5:30, and I finish around 6 p.m. or 7 p.m. The slightly tricky part is the assets my group trades are fairly complex assets, very levered. They require a lot of time to actually trade them at the right price, finding the right people to execute transactions, which means that as a researcher, I need to be involved in the portfolio management and the trading process. And my portfolio manager and traders need to be involved in the research process. So it ends up with, I start with the traders to be able to assist where they need. And they're going to finish close to where I finished to be able to send back some ideas, etc. So in itself, from that standpoint, it's a routine. The content itself during the day, pardon me, I would say depends mostly on two aspects. There's the aspect of what are the priorities from an investment standpoint. Is the portfolio performing well, not performing well? Well, if it's performing well, I can actually focus more on what's going to be longer-term research projects. If the portfolio is losing money, it means my idea sucks, right? So I need to get it and fix it. Necessarily, that means I'm not going to sleep until it's done, and that's more going to be like short-term work. So there is definitely some fluctuations there. One aspect I would think that can be stressful is, even though we say we're quants, so we're supposed to have those like mathematical models and we're in control because we backtest. Well, that's true when you're right. Like when you're right, you like your model. And then when you start losing money a little bit, you're going to be fine. And then once you start losing a lot of money, which we all hope it doesn't happen, and then sometimes it happens, then you start panicking, right? Because eventually you're still very human. And that's really where the stress happens. So to give you an example, when I started trading, so that was a few years ago, not too far long, but still, I remember my boss back then gives me some budget and he's like, watch out your loss because then you're going to get scared. And I remember one day I lost $30,000 and I was really worried. I was like, oh shit, he's going to be really mad. And he was like, what do you mean you lost money? It's only 30,000, you're not taking enough risk. Right, so it's a matter of you relativize, right? What is really stressful and meaningful versus what is not. And now a few years forward, we do manage much bigger budgets, but there are days that are pretty stressful, right? So the most recent was, for instance, Brexit, right? So UK voting to leave the European Union. So that day I started at 5:30 a.m. like every day. I watched through the Brexit vote and the market reaction until 6 a.m. of the subsequent day. I slept for 30 minutes, I went back to work. That was stressful because I was exhausted. And it's not so much that you are losing money, it's you are entering a market that you don't know how things are going to react. You are investing a lot of money on behalf of clients, so you need to know what you're doing and whether things are under control. That's the kind of stress that can show up regardless of whether you have a quant process or not. Eventually, you're in the business of making money. The research itself, I would say, is the least stressful part of the process in that you are trying to create knowledge. You're trying to resolve problems that were not necessarily resolved before or that were not resolved adequately or to your satisfaction before. So there, I wouldn't say so much it's a stress as much as the ability to sort through what are you actually trying to answer, knowing when to stop, because it's not going to be promising. You're not going to spend 10 years trying to resolve a model and 10 years later you haven't produced anything concrete. If at some point you realize it's not promising, you need to stop. That was investment into a research time. It's a dead end, that's it. And being able to prioritize, right? If there is that really cool thing you're working on, you're like, well, that's awesome. I'm going to spend 10 hours a day for the next 2 years. And someone's like, well, I need your help on something that is a problem now. Being able to quickly shift between those two priorities, realign your mind, is something that is not necessarily a form of stress, but it's a form of intellectual habit. Being able to do that, being good on the two parts, because exigencies exist on the two aspects.
Andrew, can
yeah.
just listening to these comments on stress, and I wanted to just mention, a thing that popped in my mind, which is that, when you're managing a portfolio that's levered, then there's an element of stress that arises because at some point things are out of your control, right? So if you're running a model, the nice thing about a model-based portfolio is that it strips the emotion out of the buy and sell decision, right? So you work on the model and you have confidence in it, and then in most conditions you stick with it. But if you're running a levered portfolio and you lose money, then the ability to stick with the model is no longer totally your decision, right? It can be the decision of the people who've lent you the money, and they say, you know, we no longer believe in you, and we're forcing you to cut back, and they typically do that at just the wrong time. There's, you know, I think the stress level is kind of non-linear in that sense, and that's important to keep in mind when you think about, you know, what jobs you're suited to. And in addition, when you're running a levered portfolio, you also have counterparty risk as well. And then there's additional worry about, well, do I think the guy who's holding my cash, who's on the other side of my derivative transaction, are they going to be creditworthy? So your ability to stick to your model when you kind of move out of the long-only world into the levered kind of hedge fund world isn't 100%, and that introduces a level of stress that, you know, is kind of hard to model in some sense, but can spike dramatically.
Yeah, making money is very stress-free, and as soon as you start losing it, it's immensely stressful. So I'll just open these questions, you know, to whoever wants to answer, and you know, we don't need to go down the line all night. But what makes a good quant? Like, what kind of skills are valuable? What mix of skills? What attributes in a personality are good for quantitative finance or
I'll provide some feedback based on my experience. I think what makes a good, so first of all, I think it depends on the job that the quants are doing. So in my line of work, I think good quants are people who are able to think clearly, think rigorously, and think on their own. Right? You don't want to be distorted by your priorities. You don't want to be distorted by what others have done or have said that you should find. And you need to be able to build up your own thinking process to get to the answer that you're looking for. In terms of personality, etc., I'm not sure there is a clear answer. You know, I have a lot of colleagues who are researchers. They are all fairly different from one another. And the main commonality is they are all pretty good at thinking about their area of expertise, trying to answer questions. One thing maybe that does stand out is if you were to do some form of personality test and try to look at how people think about typical situations in their daily life, I think a lot of researchers would tend to be a little more remote from feelings and from personal engagement into the situation versus others, to the point where a lot of my colleagues can tell I'm pretty weird and pretty asocial from that standpoint. So I would say it's maybe almost, you know, it's not necessarily why you were like that and that's why you're good at research. I think there is a feedback where you start being used to thinking about everything objectively. And so every situation that you face start being treated under that angle because it shapes your approach process.
There's an element to when that, you know, I think quants who are, or people who have this kind of innate kind of self-starter type personality and intellectual curiosity to kind of like, that's interesting. I wonder if anyone's ever looked at that and kind of digging around, and someone who's, you know, the type of person who's willing to take a problem that may not be so well defined and start with like, oh, it's kind of curious. I wonder if we looked at this kind of data, or we looked at the problem in this way, and have that initiative to go sort of figure out how do I dig into that? Like, there's no one to tell me where to find this data, so I'm going to have to go start looking at my own. And you know, I may not have some nice little tool to get the data that I want. So I may have to start, well, what do I have to teach myself to do in order to you know, what kind of research do I have to do to figure out how to get the data to do the research I want to do? And so that kind of intellectual curiosity coupled with sort of this kind of willingness to roll up sleeves and wade into a messy data science problem is hard to teach sometimes. And I think that you find some quants that just have that, like, let's, you know, dive into the uncertainty and start trying to resolve uncertainty and make progress. And you have some people that come from, you know, a great academic background, but, you know, in classes, like, you kind of know what you need to do for the homework to get to the final answer, and you don't know, you've got to be comfortable with it. You don't know that there will be a final answer, so you have to take some risk of like, okay, I'm going to invest time exploring this. And there's no syllabus, so maybe I need to, maybe there's some paper that I need to go find and read, and maybe that'll spark an idea that no one else has looked at, and you've got to be willing to kind of deal with that ambiguity and uncertainty, and still, jump in and start making progress in the face of it. And that's a quality that I see across a lot of quants that have been very successful.
I can't agree with you more, so I have to say something. So I think from my experience, it's more like at Twitter, when like I've never learned how to write a MapReduce job in any of my like academia training. But then when it comes to, okay, Twitter uses Scala framework, I don't even know Java, so how do I even get data? So I think what's important is that I taught myself Scala and learned Scotting to run MapReduce in order to get the data that I needed. And I think the happiest thing for a data scientist is that you have the data you need instead of like not knowing where it lives and not knowing what tool to use to get the data. And then similar things happen at Google. When I started, it's more like we have a data engineer team who does the data pipeline, but oftentimes the data that I needed does not exist in the pipeline. So what would you do? You can file a ticket and wait for the data engineer to get data for you, which will take a week. Or you can teach yourself Go, which is Golang, which is the MapReduce language we use at Google, and so that you can go in there and add the data to the pipeline, and then change the production code, submit a change list, and then you get the data that you need. And going forward, you don't need to rely on other people to get the things for you. So I think those type of things, to me, is extremely valuable. And again, to Mike's point, to be proactive and to think about, oh, I wonder, what if I look at this? I wonder, how do those people, get the data that I need? Why somebody has never looked at this? I think, thinking about, thinking kind of outside of the box and just kind of keep that curiosity is really important to what I do right now.
One question, touching on the skills aspect, data science, obviously it's the hot area, especially here in San Francisco and the Bay Area. How are you all seeing the opportunities change for people with data science skills, both within finance and outside of finance? How is that changing the industry and changing the opportunities for people with your skill sets?
I can take that. So I can speak from my experience. I was at Goldman for about 6 years, and I initially started doing some derivative structuring because the market for derivatives, it was not hot, I would say. Pre-crisis it started to come down, but some of the regulations were not impacting it as much. But over the 5 or 6 years, I've seen people worrying about less and less derivatives because markets and products became more simpler. And the need for data scientists or the people with data scientist skill sets started to pick up. And one of the primary reason was because availability of data. So in investment banking, where your goal is much more more sales-like, where you're talking to clients about any M&A transaction or raising money through debt or equity, it's a very relationship-driven business. But I saw Goldman moving towards more data-oriented approach because a lot more data was available, and there were different tools that popped up. It's not just Excel anymore. You have Tableau, you have other fancy analytical suites where you can plug in the data and try to derive trends and advise your clients using those techniques. So it's the availability of data that people have started to look at it differently, and I feel the firms that are not using the data to their advantage feel kind of left out, or the clients feel you're not providing adequate insights, and that is one of the different I have seen here at Lending Club also. The whole model is set up around data because you have so much data available from consumers that you can build a model, assess risk, and you can compete with banks banks like Chase or Citi or Bank of America, who have been in the consumer lending business for hundreds and hundreds of years. So because there is so much data which is available out there, the depth and the quality of data is increasing because of digitization all around the world, and it helps firms doing all sorts of businesses, not just finance. If you look around, Google, Facebook, Amazon, building recommendation systems, providing insights to users based on their different patterns. So I think it has penetrated almost every aspect.
Yeah, I may be biased in that I work for a firm that was intentionally founded at the intersection of finance and data science. But I, as someone who's been on the buy side of quant investing for over a decade, like, there is a profound shift that's happening. I'm the only person with a financial economics background at Voleon. I'm sort of like the weird oddball they hired, and kind of, I'm a bit off the beaten path from their perspective. I'd say my background was very typical for the types of people who went into quant investing, a decade ago. If you look at if you look at the press for the quant finance industry, there are lots of firms that are either establishing data science groups as part of their existing quant research, or there are firms that are founding, entire hedge funds based around this idea of applying machine learning and data science to investing. So it's become increasingly an area of focus and attention, both on the kind of quant research side as well as on the client side. And I think that trend is only going to continue. And I think one of the interesting things to see when I moved out to the Bay Area in 2005 to join BGI, I had personal reasons for wanting to be on the West Coast. I was really happy I was excited about BGI, but also, like, there just weren't that many firms that were going to let me do quant research and sit out in the Bay. And fast forward 10 years, and there's been partially driven by this interest in data science, a lot of firms have started to establish kind of research groups because there's such a data science oriented talent pool out here. And I think that the opportunities to practice this craft and not have to move to the East Coast have never been better. And I think there's just a growing community of kind of data science oriented quant finance that's out here that just was not like that earlier in my career, and it's exciting to see.
Can I add something?
Yeah.
In some ways it's new, in some ways it's not, in the sense that we used to say that there was a return to boredom. And what we meant that is that the time you spent taking unstructured data and putting it together into a useful data set was often the most valuable time you spent. So, collecting unstructured data, interrogating it, cleaning it, and then putting it in some sort of structure. While that was boring, and in the old days it had to be kind of almost done by hand, that's where you really had an edge. So I'm always been a believer in the value of unstructured data, and now I think you've got tools to do that over just a vastly greater potential set of data. So I really am enthusiastic about the opportunities for machine learning. It's not a skill set that I have, but I know it's a skill set that a lot of you guys have, and I feel like there's, just to echo what was just said, there's going to be a lot of opportunity to apply that in finance down the road.
Great. So I think now might be a good time to open it up to audience questions. So there's a mic here. If anyone wants to come forward and ask a question, and for any of our panelists.
Hi. My name is Lev. I'm earning my master's degree in statistics here at Berkeley. I'm getting really interested in, as a lot of you guys said, applying statistical and machine learning ideas to finance, but I don't have any sort of career background working in finance, so I wanted to ask, how might somebody like me, after graduation, start getting his foot in the door, so to speak?
I think this is typical for a lot of firms that work in kind of quant approaches to trading. Teaching someone who has a lot of finance industry knowledge how to think quantitatively and how to think about data science and how to think about financial theory is a lot harder than to take someone who has that base of skill sets and to teach them kind of market knowledge about the dynamics of corporate bonds or equities. So I think the skill set that you're building and acquiring is the one that's harder to come by, and that I think every firm I've been with is that they have some way to train you up on the more kind of institutional market knowledge side of things. So I think that you're on the right path.
Yeah, and just a few practical suggestions if you want to get some experience. So the CFA curriculum is a great resource. It's sort of self-study based, not terribly expensive to get into, although they do charge you a fee to maintain your designation once you've received it. So that's one thing to look into. Also, trading either real money or a paper portfolio on your own to get some experience in finance and the applications of your skill set to the industry. And there are also a few things, some startups and things like that actually will provide you with some pretty robust tools in order to develop trading strategies, and then may actually implement them. They raise funds behind that, and they might actually decide to implement some of the strategies you developed and put real money behind it. So I would say there are a lot of ways, and of course, an internship would be another way to kind of get your hands dirty and see if you really like working in finance before you have to commit to a full-time job.
Yeah, I think you often don't need a lot of finance experience to get your foot in the door and get that first step, but you need to demonstrate that you care enough to do something. So like what Lewis was saying, CFA is a great way. Taking even just level 1 is a great way to say, yes, I'm interested in finance. I'm not an idiot. And then you have the technical skills, because at the end of the day, the technical skills are what really matter. But you do need to demonstrate that you're not just a scientist that doesn't know anything about markets. Maybe we'll take the next question.
Hi. In a bit of a different vein, I have a question about work-life balance. So it sounds like you've worked kind of across the spectrum in finance and in more data science-oriented roles. Which roles or firms do you think have the most in-office requirement time, and which roles might resemble more of a portfolio management or out-of-office remote time, and I guess which roles might resemble more of like a standard technical job, just in terms of culture and work life?
In my personal experience as a researcher, I find that the more you're buried in research and less looking at daily portfolio, that opens itself for more, time away from the office, for example. So, I work at an office downtown San Francisco, but I've worked for months at a time remotely in Asia. My job could very easily be taken a lot of other places, because in my situation, I do a bunch of research, I build a strategy, and ultimately it goes into an index that a portfolio tracks. So, all the rules, all the logic, everything is already embedded in, the documentation. So most of what I'm researching all day long is, learning about what's going on in the portfolio, but also coming up with new ideas about new portfolios, things like that. So my time at the office, I'm there, but I really wouldn't have to be.
I'm going to add a bit to that. I would say the work-life balance to a decent extent is what you want to make out of it. I think it's very easy to get caught into feeling very stressed out, feeling like you never put enough hours because you have so much to learn or so much you don't understand that you may spend your entire day, your entire night doing that, right? And at some point, it's a personal choice. Some people want, some people don't realize they do it. I think in the quant business, you have more control over that. And you have naturally a better work-life balance than what you could find in a fundamental shop, because the person who is right is not the person who is the oldest or the loudest. It's the person who can actually come up with a good idea and prove it. And so effectively, once you've proven your idea is proven, right? You don't need to stay an extra 4 hours to keep explaining over someone else's voice why you have a better trade. So I would say a bit more in control. The flexibility of working on site versus, for instance, your home remotely wherever you want probably depends on your exact role and depends also probably on the type of business you are in. Right? So if you're responsible for putting orders, there is very little chance that they will let you do it remotely. Right? There are requirements, regulatory requirements on how you can actually place orders and where from, but there are also just constraints of the other people who are around that process will want to be near you if there is any issue or question. If your process is fully automated, even that, you may still have necessity to be in the office more often because you're still responsible for the actual execution. But I can give you examples, and it resonates with what Andrew just provided. When you do pure research, you tend to have better ideas or higher productivity of original creativity when you're remote from just looking at your portfolio every day. So typically what I do when I work on very uncertain outcomes of research, I don't know if it's going to lead to something or not, I tend to work from home. No one bothers me, no one can talk to me, and I'm going to do that for like 2 weeks, 3 weeks, 4 weeks. As long as people around are fine, meaning they know I'm still going to get my job done, then it's okay on both sides, right? But there is always a matter of what you want and what's good for you, and then people working with you what they need from you as
I'll really quickly, I think like in data science, in tech, the general culture, at least at Google or within the team, is like nobody really cares how long you work or when you show up at work and when you leave. As long as you like show up at the meeting that you are supposed to be, and then you get things done. So that's how I feel, if that helps.
Great. So I think probably we only have time for the next 3 questions, and then I think we'll just open it up, and we can casually have conversation and meet and whatnot.
All right, thank you. So my name is Jason. I am currently a master's student in financial engineering program at the USC. So first, thank you guys for being here and sharing really good stories with us. So my question is a little bit similar to the first one, but do you guys have any other suggestions for specifically PhD students from another area, such as maybe electrical engineering, who are also interested in the quantitative finance? Do you find any advantages or disadvantages for those PhD students? Yeah, thank you.
Well, I think it's very firm dependent. I think the types of backgrounds that that I recruited for in previous firms I've worked for, tended to be kind of more aligned along people who are trained in, let's say, economics or financial economics or accounting, and we wouldn't have had as much demand on the engineering side. At the firm that I work for now, at Voleon, I think almost a huge portion of our recruiting happens through, like, at NIPS, at ICML, at these kind of big kind of machine learning data science conferences where academics are going to present their work. yeah, and when you're there, you see there are a lot of other quant firms that are recruiting at the same places. So I think it's, in terms of PhD, not PhD, or what background in PhD, it's, different firms are going to have their own flavor and their own take on like what it is they're looking for. But you can kind of see some of those firms have common interests that maybe helps focus kind of where you're trying to get your foot in the door.
All right, thank you.
Hi, my name is Josiah. I'm a grad student in the stats department. And my question is about work-life balance, and it has multiple parts. How many times last week have you had dinner with your family? What time was dinner served? And did you work after dinner?
The sample was too small to be statistically significant.
I think just about every night last week I had dinner with my wife. We tend to eat dinner late because I have a long commute. So when I get home, my kids have already eaten and gone off to swim or soccer or whatever the activity of the day is. And so then we once the kids are down, my wife and I make dinner. I would say after dinner, there's 2 or 3 times where I might be checking email or just responding to someone's code review comments, or but still getting a reasonable functioning night's sleep.
You need to take control of your own circumstances, right? So every firm has its own culture. Some firms will want you to be home having dinner with your wife and see your kids because they think that makes you a better worker. Others want you to work, be available 24 hours a day. So you just have to make that part of your criteria and, like I said, take control. You may have to sift through different opportunities to find something that fits what you want. But so I would say have a firm idea of what you want, and then I think you can find it, but it'll take some work. But, and I think you learn a lot about the values of the firm by asking this sort of, maybe not exactly in that specific way, but asking, trying to get that information out of them when you interview.
Yeah, I would say on the West Coast, your chance of eating dinner with your family is a lot higher than on the East Coast. So, I will never see my wife in the morning because I start work, for market hours, but I do finish in time for dinner, and that's great.
Thank you.
All right, well, I would like to thank all the panelists, and thank you everyone for coming.